Welcome to Better System Trader, the show for systematic and algorithmic traders. And today we've got a very special guest. He has published a number of books, one called The 30-Minute Stock Trader, the other Automated Stock Trading Systems. He's also been featured in Van Tharp's book, The Trading Beyond the Matrix. Welcome, Lawrence Bensdorp.
Thank you very much, Andrew. Happy to be here.
It's really great to have you here. I know we've been going back and forth a little bit to organise you to be on the show, and yeah, I'm really excited to discuss trading with you today. So thanks for joining us.
Likewise.
Yeah, and we've already got welcomes in the chat as well. So we're all excited to have you here today. So how about first of all, it's very early here. Do you want to give us a little bit of background on yourself while I get myself together here?
Sure, no problem at all. So I'm from the Netherlands, currently residing in Portugal, lived in 12 different countries, and I've been a systematic trader since 2007. I started trading back in 2000. At a time where I basically had no idea what I was doing. That eventually led to finding my own style in trading. And going fast forward, right now I trade a suite of 55 non-correlated systems simultaneously, both long and short. A lot of different styles on full automation. And besides that, I have a mentoring company, tradingsystems.com. Once in a while, I'll host a seminar with my friend Tom Basso. And besides that, it's all about enjoying life.
Wow. So 55 trading strategies or styles. People might go, how do you ever get to that? But we all start somewhere, right? So what about, can you take us back to your very first trading style or strategy? What was that? And why did you choose that?
Well, the first time when I started trading back in 2000, I basically had no idea what I was doing. And I thought it was fairly easy with a $30,000 account to make $100,000 a year return and having a great life with that. That wake-up call came very fast that wasn't going to be the case. So it was a long time of studying, reading books, understanding things about technical analysis. And I think the first thing was that I realized that, okay, fundamental analysis is not for me. I very much liked technical analysis a lot more. Then I started to learn about trading systems, read a document about the turtles, how they traded, and that it was full systematic with specific rules. And that really grabbed my attention immediately, that I said, okay, this is what I would like to do because this makes really sense. And that was back in 2006 or so. So at that time, I started to hire programmers to turn my ideas basically into algorithms that I could test, so to actually see if my idea had an edge. And my first trading style that really resonated with me was mean reversion.
Right. Okay. So before we dig into that more, I just want to go back a step. You said that it was very clear early on that it wasn't going to be as easy as you thought. Was there a particular incident or some clues that made you think that? How did you come up with that observation?
I just consistently lost money every single day. So you get the feedback, of course, but I think above all, I had no idea what I was doing. I mean, I read about trends, then I read about pullbacks, then I read about indicators, overbought and oversold, and I had no trading plan. There was no structure. There was nothing basically. So it was all just guesswork. I was looking at the news messages. So if there would become a Fed decision, I would be glued to the screen. And at the moment when the Fed decision came out, I immediately said, okay, this is going to be a long trade, etc. So there was no structure whatsoever. And I basically lost money consistently. And that's when I realized, like, okay, hey, I'm really just gambling. There's no edge at all in what I do. If I continue like this, I will lose everything, period. So that was the trigger to say, like, okay, I really need to educate myself.
Yeah, yeah. I think the market is an excellent feedback tool to tell you that, right? And the ultimate feedback is in the bottom line or how you're doing with your P&L. So I think that your story is quite common amongst a lot of traders. I did the same thing. I tried lots of different things at the very beginning and had no idea what I was doing. And it's I guess a common story amongst all traders. How did you go from?
It seems that we have to go through that period as well to understand one's own incompetence to really realize how hard trading is. It's not easy.
Yeah, exactly. And so, did I hear you say you read 500 books or something to try and absorb knowledge?
More or less, yes. Yeah.
Wow. That's incredible. So that really goes to show that the drive that you had to, to figure this out. 500 books is a lot of books. That's like one a day for a year and a half, right? So did you find that there was not a lot of good content in there, or why couldn't you figure it after 10 or 15?
I didn't know, of course. Especially in the beginning, there were so many books that I read, and I didn't know if the content was actually good. It was just... I had a belief that I needed more information and knowledge about the markets and everything, so I just read everything. But there weren't any real books that gave me specific trading ideas of entries and exits. Neither was there anything until later that was talking about the psychological part of trading as well. So I think the books that really stood out to me and that really helped me to start to transform myself was probably the books from Jack Schwager, Market Wizards and New Market Wizards, as many traders have read and liked those books. And for me, also the book from Van Tharp, Trade Your Way to Financial Freedom, for me was definitely something that really made a lot of sense. And at that time, I suddenly got it, like, okay, there is actually no holy grail in trading, that there's one strategy that can do everything.
Yeah. So you've mentioned the word beliefs a few times now, and I know through reading your books that one of your beliefs is that you need to have, I guess, trading styles that suit your personality and your beliefs and your preferences. How did you end up with mean reversion being the first style of trading that you really dug into?
I'm a contrarian by nature. I kind of do not like to go with the herd, but do completely my own thing. So I understand very well the thing of greed and fear. And when there's a lot of fear, it is often because the herd is wrong. So when I read about that, it immediately made perfect sense to me. It was like, okay, yeah, that makes perfect sense to me. I think also at that time, because since then, my styles and my objectives and my beliefs have changed and evolved, certainly. But at that time, because I was younger, it was, for me, a great trading style because mean reversion was a shorter term style with a high win rate generally. And that was something that really resonated to me and what I really thought that was a comfortable way of trading, instead of being a trend follower that appeared to me a lot more boring and crowd following, basically.
Right. Okay. That's interesting. I was thinking about this myself when I was reading through your books, is that, when I first started trading, I had this belief that I needed to trade all the time. I had to take lots and lots of trades. And I started out doing trend following, and I was quite bored by it because it was just like
Yeah.
I wasn't taking a lot of trades, and I was a very impatient young man, as I'm sure a lot of people that age are. And I also had problems with I always wanted to be right, and so the low win rate in trend following kind of irked me a little bit, and so all those things kind of pushed me away. But as I get older, I get more patient. I start to realize these other things. So it's interesting to hear you talking about your own transition there. What I found fascinating about your comment is you actually listed a number of different factors to why that trading style, suited you. So what factors can traders look at to kind of find out, well, what's really the best style for them?
So what is it exactly? What your question is? Like what?
How can traders figure out, without going through the 500 books and testing all these different trading styles and losing all this money, how can they kind of shortcut the process and go, okay, I need to take into account these factors. This trading style might suit that.
I think there's a couple of things. It's as I mentioned, win rate is incredibly important immediately. Some people are just not geared towards a small win percentage of trades. I think the other thing is trade duration as well. And also, I think what a lot of people need to take into consideration is that whatever style they come up with, it won't be a style that makes money in every market environment. So, for example, if you say, I really think that trend following is for me, that probably also has to do then that you look and you like to look at the S&P 500, for example. You want to beat the S&P 500. But with a style like that, you also need to understand that there will be times where you could be like 2 or 3 years without making any money. Now, if you have a mean reversion system or another kind of system with a higher trade frequency, that means that you have more chance to climb out of that drawdown. So there's a lot of pros and cons basically that you first need to take a look at before understanding. I think reading about simple styles is something that can really help you, and you could see like, okay, do I like trend following? Do I like mean reversion? Yes or no? But also, do you like short selling? Yes or no? Some people like it. Some people can't do short selling because of trade regulations and stuff like that.
Yeah. So, how do traders go about validating their beliefs in the market? Because as humans, we have all kinds of biases, and you could look at a chart and see one thing, and I could look at it and see completely the opposite thing. How do you go about validating whether your beliefs actually align to something that could be profitable in the markets?
You need to be 100% comfortable with the pros and the cons of every trading style. So if you have a trend following system, you need to be comfortable that you could get 20, 30 trades that are losing trades. If you want to be a trend follower, you need to have the belief, the core belief, that you're hunting for that big outlier.
Right. Okay.
Reversion, it's basically that you will see that you have a higher than normal win rate, but on the other hand, the average win loss is close to 0, close to 1 basically. And that is kind of the two differences that I think that if you see that is those are the statistics, then you can validate like, okay, this is what I like. This is how I like to trade. I think very often as well, it is something that one finds out more while trading live. Sometimes you read something and you say, okay, this makes total sense to me, but then you trade it but then the live trading experience can be very, very different. And it's like, oh gosh, I don't like this at all. I'm selling short those stocks, and the back test looks very nice and everything, but in live trading, the experience could be very different as well. So it is also quite an evolving concept, I would say.
Yeah, I think you touch on a really good point there. I think sometimes there's a disconnect because traders, they backtest these strategies, and it excuse me, it spits out this really nice looking backtest report, right, with this pretty smooth equity curve, and you go, that's great, I'm going to trade this thing. And then when you get to the live trading, you don't see all the little bumps and the daily gyrations, right? And so the expectation of what it's going to be like and the actual implementation or the experience of that can be very different. How can traders kind of get that experience in a safe manner without, blowing themselves up?
Best way to do it, if you have a back test, that you actually start to zoom in and not only look at a 20-year back test with a wonderful 45-degree equity curve from lower left to upper right, and say, oh, I could do this, and oh, I could handle the drawdowns because I see what the outcome is. Because in live trading, you get the day-to-day feedback. Many people say that is so great about trading. I think it's the hardest thing there is for trading, actually, to have on a daily basis your P&L. So what you can do, if you have a back test, that you actually zoom in and you start to look day after day or week after week what the returns would be. And especially take a look at the time when you see where your largest drawdown was or your hardest time in your back test. How would that feel? How would you feel if you're 8 or 9 months without making any money and you're 15% down? Because again, on that wonderful equity curve, you say, okay, it's no problem at all. But then in live trading, it can mean that you're just completely fed up with it and say, okay, I stopped doing this. Now, if you zoom in a lot more, and then you start to actually building up a lot of mental scenarios in your head where you say, okay, let's say I'm trading this with $1 million. And right now at that time, I would be down $150,000. Could I still deal with that? Yes or no? So trying to make the simulation actually as real as possible as what live trading would be. That is probably one of the things that I really, really recommend. And then the other thing is, the moment you trade live, do it small. Don't start immediately with a big chunk of money, because then your emotional side is most likely going to take over from your rational side. And that is not what you want to have, of course.
Yeah. And continuing on with this backtest report or backtest theme, it sounds like there's 300 metrics on these reports, right? It can be a little bit crazy to look at. Do you look at any particular metrics, or because you're speaking a lot about trying to understand the experience of how it would be to trade this strategy? So what do you really focus on when you're looking at backtest reports?
It depends on the strategy. If you develop, I think there's a lot of metrics, as you said, like Sharpe ratio, MAR, whatever, Sortino. There's too many to mention. First of all, it's important to know that all of them are just a representation of the past, no indication of the future. But secondly, the one thing that I most look at is this system, when is this system supposed to make money, but when is it likely to lose money? And especially if you understand that second question, that will make your life so much easier. So, for example, a long-term trend following system, this year in 2023 on the S&P 500, NASDAQ 100 was a wonderful time. But you were supposed to be down in 2022, 2008, etc. So if I see that in a backtest, then I say, okay, this is solid. This is what it's supposed to be. So it really depends.
Right. Okay. Well, that leads nicely into, I guess, diversification, because as you mentioned earlier in our discussion, your strategies aren't always profitable. Say, for example, you've decided that trend following is going to be your thing, and it really aligns with your beliefs. And how do you go about diversifying with just one particular trading style? Because you mentioned you trade 55 different styles, and I heard you say trend following and mean reversion in there, which are both very different stylistically. How do you address diversification if you're specialized in one thing only?
So you start to look at what you have, and then you see what the weaknesses are of that strategy. So the basic example is a long-term trend following strategy. And let's say you run a backtest from 1995. It's supposed to make money from 1995 to 2000. Then you get the .com bust scenario. So you will see a big drawdown there from 2000 to 2003. And those are the time periods where you need to take a mark on to say, okay, they are losing money during that time. They're supposed to lose money at that time, right? So then the next thing is, and that turns then into an objective to say, okay, what kind of strategy can I find that could capitalize during the times where the trend following strategy would lose money, and this strategy would then make money, but at the same time, in other time periods, would not give back too much money.
Right.
So what you then get is basically that big long drawdown. If you add or overlay that with a trend following strategy on the short side, or it could be a mean reversion strategy on the short side, you kind of fill up those holes, which to me is incredibly important, that you always take a look at the holes. And with the holes, I mean, if you see an equity curve of a 45-degree is wonderful, but normally you will see an equity curve that is a lot more, goes up and down, and is a lot more bumpy. It's a bumpy ride. So what you need to find out is what happens during those bumps, during those drawdowns of that strategy, and that offset that with another strategy.
Right. Okay. So when you started out with mean reversion, what were the holes that you saw in that style that made you want to investigate other trading styles?
Yeah, that was a good question, because I thought in the beginning, like, okay, this is everything that I want to trade. It suits me perfectly. I think 2007 to 8 to 9 were very favorable for mean reversion. I traded both long and short mean reversion, actually. My biggest wake-up call was 2011 August. And you remember the time, I suppose, right?
Yes.
And my mean reversion long systems, they got hammered. They got hammered in a way that I just could not believe it. And one at that time would think, well, but you have your short selling systems. Yes, but those were mean reversion short selling systems, and the market dropped down with so much momentum, so there wasn't an upward pullback. So I didn't get any fills on the mean reversion short systems. So suddenly I was totally net exposed on margin, because I didn't have that much money at that time yet, but a very high confidence that my strategies were doing good. So I got a pretty decent beating at that time when that happened. And then that was a huge wake-up call for me, because I said, okay, damn, what happened here? I couldn't believe it. And I started to analyze that. So the first thing I did is lower my position sizing by 50%. So I could get my rational back instead of being very mixed up about all my emotions about the dollar amount that I lost. And okay, yeah, this is what is missing over here. This kind of strategy of just selling short, for example, when the S&P 500 is below the 50-day exponential moving average, would have gotten me in a trade that would have lowered that drawdown maybe by 50% or so.
Yeah. It's a funny, well, it's not a funny story, but it's the reason why I was smiling when you were saying that is because I had the exact same experience. I was trading mean reversion strategies during that period, and my strategies took a hammering. And in fact, I pretty much blew up my account because I was trading on leverage, and that was probably my first really big drawdown. And emotionally, it was very tough. I stopped trading for a while. I blamed the market. I blamed the computer. I blamed everything else. But over time, I kind of realized this is actually a learning experience for me. There's a lesson here. And that's probably one of my biggest lessons in trading was that moment. And I'm so grateful for that. But at the time, very tough. It was very tough. And I gave up trading for a while. What about you? How did you get yourself through it emotionally?
I was doing at that time quite a lot of psychological self work already, so
Right.
I was able to deal with it from an emotional standpoint of view after the first shock. I mean, first you're in complete shock, like what the heck happened here? I can't believe this. But then after that, I was able to kind of look at my awareness, work on that, and the first thing was like, okay, I needed to find out what actually happened. Why did I lost money? As I said, if you know why you lose money, it's so much easier. Once I found that out, I knew that in my approach, it wasn't that there was necessarily a flaw in there. It's just mean reversion long, short only in a time like that, or possibly a time like the COVID crash as well, could hammer a lot of accounts big time. So because I wasn't emotionally that attached to it anymore, because of my self-work, I immediately started to look for solutions that were non-correlated to the stuff that I was doing already. And that's when I suddenly found out, like, okay, I need a lot more systems, basically, for other scenarios that could possibly happen where mean reversion only is not working.
Yeah. Did that also shift your focus in some way? I was just thinking back to my experience that up until that point I was all about profits and trying to leverage up as much and make as much money as possible. And from that moment, my focus, I guess, shifted completely to risk management and being more selective about the times when I do trade. So how did that experience switch the way you look at trading?
Oh yeah. I looked at that from that point on. I immediately looked at it like, okay, one thing is your back test, but if your back test says that you had a 15% drawdown, your largest drawdown is always in the future. And I did not know that before that time. But the market teach one a perfect lesson then and shows it that it actually can happen. So I said, like, okay, well, I need to expect for myself that I will have a drawdown that can be at least double the size of my back-tested drawdown. So I need to take that into consideration as far as my position sizing and risk management to make sure that when I am in a drawdown, that it is a drawdown that I can emotionally tolerate. So basically, my trading was at a position sizing style that was very exciting, and I turned it into boring. And that's, I think, as far as the execution is supposed to be boring in trading. You should be completely detached for it and not really be worried at all what your daily P&L is. And that is only possible if you put down your risk to a level where you're comfortable with it. So we always need to be first a risk manager and then a trader.
Right. Okay. Yeah, that's I found that's easy to say and difficult to do until you build up that muscle, right? How can people build up that muscle? You've mentioned that they can reduce the position size, but is there anything else that they can do to kind of get more?
I think
more
position
confidence?
sizing is probably there the most important part, which has
Right.
to do with your psychological profile, of course. And I think what is important is many human beings have a tendency that they want to get rich quickly, whether we like it or not. We have that all in us, but that is the biggest trap there is, because if your position sizing is too large, there's a very large likelihood that you will suspend your trading. Guess at what time? The worst possible time, when you're in your biggest drawdown, when there's possibly nothing wrong with your system, but you say, okay, I'm out of this because I just can't handle the dollar amount that I lost anymore. If you look at it from the other side, actually, and you say, okay, I understand the law of compounding. Even if I aim to only get 15% compounded annual growth rate per year, that means that still every 4.7 years you double your money. That is a lot better than the alternative, where you bail out with a 30% drawdown, feeling miserable, and probably for many people don't want to ever know about trading for quite a long time.
Yeah, yeah. I think you touched on a really good point there, and I myself was my objective when I came into the markets was to make a lot of money very quickly, and didn't turn out that way. I know you work with a lot of traders. What kind of mistakes or challenges do you see traders coming into trading with their objectives? Like, is there false expectations, or what kind of things do you see that traders kind of stumble with?
Initially, most people say they want to make as much money as possible with as low risk as possible. And that sounds familiar, right?
Yes, very familiar.
And we all know that it's not really possible like that, because everybody has a very different personality. Let's say if you're somebody who really likes to look at what the S&P 500 does, and if you then trade short selling strategies, it's not going to work that well. If you really want to beat the benchmark the whole time, if that is your profile, then you should trade long only, most likely trend following only. And I think many people, they have an issue with that it is a lot better to trade the strategies that you're 100% comfortable with versus trading something that is more complex, could possibly be better, but you're not comfortable trading it. But also, for example, I've worked with money managers that have specific rules and requirements, because they need to think of how their clients think. And their main job is to make sure that their clients stay on board, right? So they need to design a strategy that makes sure that they can increase their assets under management and stay in the game, basically.
Right. Okay. So what you're saying then basically is a strategy that aligns more with your beliefs and your personal preferences is more important than one that's been rigorously backtested. Is that the conclusion there?
Absolutely, yes. I think that's absolutely true, because I could give my 55 suite of systems to somebody else and all the rules, and they would immediately tweak it. And interestingly, my seminar partner Tom Basso, we spent a complete morning in my office when I lived in Spain. He visited me over there with the objective basically to compare both our strategies. And Tom, I mean, he's famous ex-hedge fund manager guy, market wizard, of course. So I kind of knew already how he traded. And we compared both our stuff. And we came to the conclusion, like, yeah, both things have a phenomenal edge, but I could not trade Tom's stuff. Tom could not trade my stuff because there's just some core beliefs that are against the person. If it's not created by yourself, it needs to be your own brainchild. If you have developed it from the core, you know its strengths and its weaknesses, then basically it helps you to go to the good, but also through the bad times. So very often when Tom turns his hedges on his S&P 500 system, I get a lot of long orders, actually, my mean reversion system. And that's totally fine. It's two complete different styles, but one needs to accept what you are comfortable with.
Yep. So how do you manage periods in the market like that? Because even if you're diversified, sometimes you'll just get days where that diversification doesn't work, right? Or maybe not days, but weeks or whatever. Do you use hedging, or how do you kind of approach those times in the market?
Yeah, I mean, I trade trend following long, trend following short, mean reversion long, mean reversion short. Then I've got trend following for diversified instruments, commodities, etc. I have strategies for special situations, for example, when there's V-shapes in the market. I try to make my strategies as diversified as possible. So even with the trend following strategies, I have trend following strategies that have a 25-day look back. So you enter very early in the trend. They're not necessarily the best performing strategies as far as compounded annual growth rate and maximum drawdown. But at the beginning of that trend, you're making a huge amount of money. I also have strategies that use like a 250-day look back. So I really try to spread it around as much as possible. Same with mean reversion strategies, strong pullback, medium-term pullbacks, shallow pullbacks, and making sure that you create as many as possible different return streams, because especially with stock trading, there's a lot of variability in your system because of the corporate risk that you can get with stock trading.
Yeah. Now I know you you studied a lot of Van Tharp, and Van had a concept which I can't remember what he called it, but it was like market regimes or market moods or market quality or something like that. And he would talk about how some strategies work great in specific markets, and then typically as the regime changes, that's when you get into a drawdown. Do you use that approach? Because 55 trading strategies is quite a lot. Do you have times when you switch them on and off?
No, not at all. I just let the market, but the specific strategy tell me when it's time to be in. But generally, you can expect when you use, I use for some strategies, I use a market regime, like only trade when it's above the 200 daily moving average, for example. Right. But I don't switch strategies off. I think for trend following, it doesn't make sense at all, because trend following gets switched off already automatically when the market starts to decline. I think for mean reversion, you could do that, for example, or you could find an algorithm to say, okay, if this specific strategy is not performing anymore, I switch it off. But there's pros and cons to that, and we're working on that right now to have that back tested as well. But the moment you add a rule to say you switch a system off, first of all, you add another variable to your set of rules. Secondly, you make a prediction that from that time on, that specific strategy is not going to work anymore. Generally, the indicators are less than random as far as predicting what is going to happen. So a good example is, for example, in the years 2017, 2018, and 2019, all my day trading systems did not make money. And I had a lot more strategies, so the impact on the account wasn't that big because I had a lot of other stuff that was doing very well. But especially in 2019, it definitely lowered the performance quite a bit. But I looked at the strategies and I said, well, there's nothing wrong about it. They weren't over optimized or anything. And I couldn't find a reason to suspend those systems except for looking at a recency bias. Then, so I continued to trade those strategies. Then came 2020. COVID made huge amount of money on the downside and on the upside with those strategies, and those specific strategies were the best strategies for me in 2020. So to me, I think it has pros and cons. I do understand from a psychological standpoint of view that it can be comfortable to switch a strategy off. In my case, trading 55 strategies, I say I don't care at all. And I think for most of people that I work with as well, they end up with quite a lot of strategies as well. It wouldn't make a lot of difference as long as the strategies are very well designed to be different. So you have those different return streams.
Yeah. We've got some questions in the chat, which we'll get to in a moment, but I just want to dig into a little bit more about, so you've mentioned simple strategies a number of times, and you're just talking about the design of strategies there. Do you have some kind of guidelines or rules around how many perhaps parameters or indicators you might have in a strategy, kind of to keep it simple?
Yeah, I'm a big fan to keeping it very, very simple. So for stock trading, a long-term trend following strategy, you could have a market filter, you could have one trend filter, and then you have a ranking if there's more setups than your position sizing allows, and then a stop loss and a trailing stop. That to me would be ideal. So very few parameters. I know a lot of people like as well to have market exits and stuff like that. That could be possible as well. I personally am not a fan of that, but I know people who have and are very successful with it as well. But if you go above 6 or something, you really need to ask yourself the question, why? If you have 7 or 8 indicators, do you have those 7 or 8 because it improved the back-tested return, or is it because you designed them in such a way that they work together? And if that could be the case, then it could be okay to have more if there is a valid concept behind it. But the worst what you can do is have 2 or 3 rules basically, and let's say that gives you a 20% compounded annual growth rate and a 40% drawdown, and then you're going to add 5 more rules to lower that drawdown by another 10%. To me, that is completely curve fitting to the past data that you have, and will decrease the odds of having a robust system in live trading. So it's all about simplicity, but then multiplying simplicity with different systems.
Yeah. So people, or some traders may think, wow, 55 strategies, I could never get to that. That seems excessive.
Sure.
How do people go from maybe just one or two up to there? What would you recommend that they do to work their way up to having more strategies?
I would start to see what you have as far as a style. So if you have a trend following style, let's go one step back. First, long and short, because those two can really offset each other incredibly well. They can hedge the non-performance of the long systems. So definitely go long and short. Second step would be diversify in type of strategy, mean reversion and trend following. And then the third step is to really change the rules of every single system as well, with lookbacks, a 25-day lookback for a trend or a 200-day lookback for a trend. It gives a complete different system. The other thing I would say is that somebody can do immediately is add a non-correlated portfolio to it. So a very diversified portfolio with gold, oil, metals, grains, etc. That gives another level of diversification. It is no guarantee that they will not lose sometimes at the same time. That can definitely happen, but you increase the odds that you have better diversification. So then you already are at like 7 or 8 strategies, fairly easy. And one of the reasons is that I move up to so many more strategies is because I want to lower the corporate risk of the stocks that I'm trading. But also it takes the variability of future returns to a lower level because you've got different streams of returns.
Yep. That was some great tips there, Lawrence. Thank you. And now let's go to the chat. We've got a couple of questions about mean reversion in here. So I'll put it up on the screen and let's see. Okay, this first one is from Antonio. Lawrence, how would you describe your version of mean reversion? Do you measure range expansions and do you do live benchmarking?
So my style of mean reversion is very simple. Like at least the core mean reversion systems that I trade, they look for a trend that could be a longer term trend or it could be a shorter term trend. Generally, I want to trade that on a large basket of stocks that are fairly volatile. Once there's a trend established, then I look for a pullback. And then the next day I enter the market on a lower price than the previous close. So you're kind of catching a little bit of a falling knife in an uptrend. You then place a large stop loss. And the idea of the large stop loss is that it's not really supposed to hit it, but it's there for an emergency stop, but also for position sizing. And then you just look for a profit target, look for when it reverts to its mean, which could be a 4% profit. It could be one average to range profit. It could be that the close is above the 5-day or the 4-day simple moving average. It could be that today is the first day that the stock closed up, and then you close the position. You could add a time-based exit to that as well to say you really want to have a large trade frequency because since you have a low expectancy, you want to have a lot of trades. So you don't want to stay too long in a strategy that doesn't make that small return. So that to me is the basic mean reversion, and you can make a lot of variations around that.
Yeah. Antonio has a follow-up question here, which is a good one. We touched on a little bit earlier with mean reversion, the psychological damage. How do you deal with this when they make it look overextended? Then you get in and it defies all logic, keeps pushing and pushing more and more. We've all been there.
And this is something that, generally speaking, this is a stuff that with mean reversion, you do not see that often in your backtest, but you do see it in live trading more. So the first thing is, if you have a mean reversion strategy and it tests with a, let's say, 20% compounded annual growth rate and a 40% drawdown, I would say that's probably quite realistic, actually, that actually could happen. So be careful, because if you then start to add all kind of rules, what you're doing is all those big fat tails that moved against you, you're kind of filtering them out. But that does not guarantee that doesn't happen in live trading. So I think first of all is to have clear expectations of what can happen. What I do on the short side for mean reversion systems, I think many people remember the meme stocks rally, end of 2020, beginning 2021. And that was a time where definitely a lot of mean reversion short systems got hammered. And when I looked at that, and of course my mean reversion short system suffered there as well, that was one of the few times where I added a rule to my system. And the rule was, I said, I'm not going to trade a stock that has more than a certain amount of huge volatility over the last 2 days, because it means that something weird is going on. If a stock on average moves more than 20%, 25 or 30% in a day, then I don't think that a measurement of an RSI is of any use. So that's how you can kind of lower that a little bit. But once in a while, with mean reversion strategies, you're just going to get hammered. So make sure it's not your only strategy. Have different ones that will be in different stocks is a lot more important. So when you get hammered on one stock, that the overall impact is not so big.
Yeah. I think you raised a very good point there, Lawrence, because those occasional losses in mean reversion, if you're not careful, it's very easy to optimize those out or to adjust your filtering so that they're gone. And that's only a small number of instances typically compared to the amount of wins you get, because it's a very high win rate type of style trading. So I found that was one of the things that caught me out at the beginning, is I was optimizing those occasional large losses out and thought, beautiful, look how smooth this line is. And it was a very different experience in real life trading. So
exactly. And for example, with that short selling system, that extra rule that I added, it decreased my back tested returns on all of my systems, but I felt a lot more confident on having it in my suite of systems, because I said, this makes perfectly sense. So sometimes even if you add a rule because it makes very good sense, but if it therefore drops your compounded annual growth rate by 3 or 4%, but therefore you have less of the fat tail surprises against you, it's well worth it to me.
Yep, absolutely. Yeah. Okay, we've got a question in the chat here about about your mastery school. So maybe we'll come back to that one in a minute. Well, actually, Lawrence, can you share, like, how can people get in touch with you or learn more from you? Where can they go?
Sure. So they can go to tradingsystems.com. There you will find information as well about my mentoring program. There's some videos in there as well. You could email me or my business partner, Alexei, at info@tradingsystems.com. And you can find me on Twitter, of course, or on X now as well, at the handle Lawrence Bensdorp.
Yep. Okay. So this person, who is it? Oh, Zoran, wanted to know more about the course. So is it best that he contacts you directly? through that email
Yes,
address?
that's probably best, but just go to tradingsystems.com. You see an outline over there, but in a very small recap, because I don't want I'm not here on the podcast to promote the program. I really like to help the people who are listening, but it's a 4-month program. We do a psychological part. We do 3 months of development part. There's a position sizing part, and there is a going live part. But there's a lot more involved, and generally we request that you send an application. We look through that, and if we think we can help you, then we get in contact with you and we schedule a call and see if there's a fit.
Yep. All right. Thanks for explaining that, Lawrence, and thanks for the discussion today. It's been really great talking to you, and I'm sure the audience has appreciated it. So anyone who's watching this live or you're catching the replay, please remember to hit like and subscribe to make sure that you get notified of any new content that we release on Better System Trader channel. Now, Lawrence, just to wrap up now, any closing thoughts? You've covered a lot of, or you've shared a lot of great trading experience and knowledge today. Anything you'd like to wrap up with?
I think the most important thing is that people find a style of trading that really suits them. But secondly, and probably the most important part, be aware that your largest drawdown is always in the future, and therefore try not to shoot for the moon. I've seen too many people blowing up their accounts with a strategy that there was nothing wrong with. You generally, when you trade very aggressive, you tend to feel very miserable when you're in those huge equity downswings. So to everybody, I would say, take it easy, be very careful, be a risk manager first, because the whole thing about trading is to stay in the game. If you're able to stay in the game with a mediocre system, that's 10 times better with having a too large position sizing of a better system, because you will bail out when it goes against you too much. So whatever you think you can handle as far as volatility and drawdowns, please cut it in half.
Wow. What great advice. I wish I had that 20 years ago. Would have
Same
made
for
my
me,
journey a lot
yes.
smoother. I learned the hard way, and Lawrence did as well. So take that advice. Thank you very much for sharing that, Lawrence. What a great way to end the show. So thanks for joining us today, and thank you everyone for joining us as well. And Lawrence, I wish you all the best.
Thank you very much, Andrew. This was very much fun, and I wish you a great day. It's still early over there in Australia, and I'm going home now, and soon it's bedtime already for me.
All right, excellent. Well, thank you. Enjoy the rest of your day, what you've got left, and we'll catch you again soon. Cheers.
Excellent. You take care. Bye-bye.
Bye.